Welcome everyone. Today we're going to be talking about the 60/40 portfolio and how it did during the coronavirus crash. Now going into the coronavirus crash, I realized this year I could contribute to my Roth IRA, so I opened an account just to test out the 60/40 portfolio and how it would do with the coronavirus crisis. For the year 2019, I contributed $6,000 to this account, and for the year 2020, I also contributed $6,000 to this account. Now, the problem with that is that for 2020, I have already exceeded the modified adjusted gross income limit, and so I'm going to have to take money back out of this account. But for the purpose of this video, let's proceed and understand that this is a Roth IRA account with a $12,000 total contribution, and this happened in February. So I have a screen recording going here, and you can see $12,000 was put in the account, and this is the graph showing the decline in value as the coronavirus impacted the market. So back on March 23rd, the account had gone down from $12,000 all the way to $9,468. So that's a very big decline. That's over $2,500 lost in account value within looks like about a month. So very quick decline. The coronavirus was not kind to the markets, but luckily this was a 60/40 portfolio. That is 60% in stocks and 40% in bonds. And I just did a two-fund approach with this to keep this video as simple as possible. Now on March 23rd, I was in 60% stocks, 40% bonds, and I realized I had an opportunity to take that money that was preserved in my bonds and put it towards the undervalued stocks. And so I increased my holdings in the stocks to 100%. And of course, at this point, the market shot up because the market was pretty undervalued at that point. And I then returned the portfolio to the 60/40 allocation. And so let's see what happened at the end here. Just this past week, this account was back up almost to its starting value, $11,922. So while many people are looking at their retirement accounts and seeing how much they have declined, this simple approach that I'm demonstrating to you right here shows very little loss. And so that's what's most impressive about this 60/40 approach. The 60/40 approach gives you the opportunity to purchase more stocks at a discount by keeping your money safe in bonds. So let's look at my transactions. All right, so going into the transactions, you can see that in February, I contributed $12,000 to this account, and initially I had put 100% into stocks in the form of a total index fund, VTI. I also read the news at this point and saw that coronavirus was going to impact the market. So I sold off 40% of that stock and I put it into bonds. You can see that here. I sold 29 shares of VTI and bought 59 shares of BND. As the market declined, I continued to rebalance. I continued to sell off the bonds and buy more stock. And then on March 23rd, when the market had got to a very low point, I said this would be a really great time to buy stock. So I sold off all of my bonds and I went to 100% stocks. I bought 37 shares of VTI here at $111 per share. And now only 1 month earlier, this same ETF was trading at $169 per share. That's an insane discount. And so this is exactly what we want to do. We want to buy stocks at the low price and sell them at the high price. In 2 days, just from 2 days when I did that, the stock market bounced back and I sold off 30 shares of VTI at $126 a share. And I returned this portfolio to the 60% stocks, 40% bonds. And then as the market continued to climb back up, I would sell off these shares of the ETF here. See, I sold VTI here and then bought more bonds. And so that's what you do. You continually rebalance. When there is a large opportunity, like a massive stock market sell-off, you can sell some of your bonds and buy that discounted stock. And that's exactly what I did here. And that is one of the biggest merits of the 60/40 portfolio. And it is the most often ignored merit when you are studying the textbooks. When you are studying the statistics on this, they follow the track record of the 60/40 portfolio as if you are only going to stay in the 60/40 portfolio the life of the portfolio. But when you are actively managing a portfolio, you should not do this. You should think dynamically. When there is a big opportunity to purchase those stocks at a discount, you can take those bonds and purchase those stocks. That's exactly what I did here. You can see that this is a very simple way to offset the market volatility. And so that is the merit of the 60-40 portfolio, and I don't think that it is fully realized. So I wanted to make this video and share it with you. That was why I said it was a good opportunity to rebalance when I went over the 4 R's of the recession. That is all I have for you. Thank you for watching. Make sure that you enjoy your car.